Welcome to Stock Investment Analysis for another in-depth analysis, this time for Energy Transfer, ticker ET. My goal for this video is to give you a close look at Energy Transfer to help you better determine whether you want to invest in this company with a massive dividend yield. We will discuss the dividend, growth, valuation, debt, potential returns, future directions, and potential risks. My hope is that not only will this video help you better choose whether to invest in Energy Transfer, it'll also help you better understand how to evaluate companies and do your own research. When you hear another YouTuber saying to go buy X stock, I want you to be able to critically consider that stock for yourself and decide if that is an investment for you. Please hit the like button, subscribe, and hit the bell so you never miss a video. First, let's talk about what Energy Transfer is. Energy Transfer is the largest energy MLP or Master Limited Partnership on the planet. It is primarily a midstream MLP. Now, what does all that mean? A Master Limited Partnership is simply a company with a particular tax structure in the United States. A REIT, or a real estate investment trust, is another example of a stock with a unique tax structure. An MLP is taxed as a partnership. For the sake of this video, I won't get into the details of taxation, but simply know that there are certain tax advantages the U.S. grants to these companies, but they require a different tax form called a K-1 when taxes are done by shareholders. Now, I mentioned that they are a midstream company. What do I mean by midstream? Let me show you. There are three categories of energy sector companies. You may have imagined that an oil company, for example, would explore, discover the oil, drill for the oil, collect it, transport it, refine it, and sell it. In reality, most energy companies only focus on part of this process. Companies that conduct the exploration, discovery, and drilling are called upstream. Examples include Saudi Aramco, ExxonMobil, BP, Royal Dutch Shell, and Chevron. If you own one of these companies, that is their primary focus. Downstream companies refine the oil and create plastics and other products with it, which are sold to companies and consumers. Examples of these companies include Marathon Petroleum, Phillips 66, and Valero. So how does the oil or natural gas get from the upstream companies to the downstream? You guessed it, the midstream companies like Energy Transfer transport them, hence the name Energy Transfer. Midstream companies transport oil by trucks, barges, and pipelines and also provide storage as the oil is ultimately sent to utilities, industry, or residences. For natural gas, they again rely on pipelines and oversee gas processing and something known as fractionation, in which gases are further separated. Look at this chart here. To compare this natural gas process to cereal, the gas processing is sort of like separating Captain Crunch cereal into the yellow rectangles, the berries, and the cereal dust. Fractionation is like taking those berries and then separating them further into different colors. We end up with separate gases like ethane, propane, and butane, and so on. The assets necessary to do what Energy Transfer does are massive, and building these pipelines requires not only an incredible amount of capital, but also government permits, economic impact studies, and an enormous amount of red tape. This offers some protection and a moat. In this map of the US, we can see their various pipelines and facilities for oil and natural gas. Adding to the moat, the energy companies that work with Energy Transfer and use its pipelines to move their products enter into long-term contracts in which they pay fees. These contracts offer more stability and again offer a moat as other companies are unable to take their business while the contracts are held. ET now has over 90,000 miles of pipelines across 38 states, and 30% of the US's natural gas and crude oil is transported on their pipelines. Let's take a look at my custom spreadsheet to analyze. As you can see, at the time I made this video, this is a $23 billion company. Earnings per share growth has been at the double-digit rate for the last 1, 3, and 5 years, which is excellent. At 10 years, it's just under 10%, which is still good. Looking at cash flow, it is negative this year, and the average of the last 3 years is slightly negative. This should of course give us some concern, although most energy companies have also had a considerable drop in the last year. Price performance took a huge hit this year and has declined across the last 5, although it remains positive for 10 years. The company has not been public for 20 years, and thus there's no data at 20 years. In summary, the historical growth is solid in terms of earnings, but poor for cash flow and price performance. However, it is because of the recent poor price performance that I believe there are opportunities for future capital appreciation. Also, if you stick around to the end of the video, I'm going to show you another chart which has other growth metrics, and I think you'll be very impressed. Let's look at forecasted growth. It is expected that earnings per share will grow at about 5% annually. FastGraphs predicts that, based on projected growth and its currently significantly depressed valuation, capital appreciation should skyrocket over the next several years, and we could see a $13.28 share price on an Energy Transfer share, which is currently trading at only $8.53. Bear in mind that the current $8.53 share price is at the time I made this video, and it will likely be different when you see this, as these share prices have fluctuated a lot lately. Let me demonstrate this for you on FastGraphs. This chart shows EBITDA in dark green and price in black. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. You can see EBITDA grew rapidly up until 2019 and had a decline, which has since flattened and is expected to remain flat. This blank section in 2007 and 2008 is missing data. You can see the share price became significantly overvalued here between 2013 and 2015. When the price plummeted, people lost a lot of money. This is a good example of why buying overvalued companies is risky. Currently, this stock is very undervalued relative to EBITDA and even relative to its own historical share price. We will talk about why at the end of this video. If the share price was to return to fair value based on its 16-year historical price to EBITDA rate of 4.6, we would see a 41% annual rate of return. However, I think that it is unlikely to occur because the normal price to EBITDA calculation is being driven up by this insane share price spike. What if we look at just how the company has traded since that share price fell? Based on price to EBITDA since that time, we are likely to see a 25% annual return to the end of 2022. This is a combination of share price appreciation as it recovers and a massive nearly 14% dividend yield. We want to buy when companies are undervalued specifically because of that rapid appreciation we can see. For example, for those who bought at the bottom at $4.60, they have already had 92% returns. Although I did not buy as low as $4.60, I began to add in at just over $5.60, as you can see from some of my purchases here in March and April. Share prices have already surged since, but looking at fast graphs and other data, I believe it will continue to increase and pay a dividend like the one I received here last month. That's almost $500 on a company that was yielding over 20% when I bought it. FastGraphs forecast calculator predicts that, based on the normal price to EBITDA multiple, we could see 22% annual returns, resulting in a $13.81 share price in several years. That's the same number I had on that Excel sheet. Using their estimates calculator, it looks similar with a 21% rate of return and a $13.21 future share price. Compare that to the analyst mean share price target and the median price targets of around $12. To explain that difference, it is partly due to relying on different data, but also because their price target is for next year. FastGraphs is for the end of 2023, and it is thus a higher price. Please note that Finbox is calculating a much lower fair value, although I am unable to tell you exactly what they are basing this on. Let's look at dividends. If you buy Energy Transfer, dividends are the number one reason to do so. At the time I made this video, the yield was an enormous 14.3%. And just so you know, for Energy Transfer, technically they are called distributions, but for the sake of this video and for my viewers, I'm going to refer to them as dividends as that's something that we're more familiar with. Essentially, they're going to be treated the same. Now, even if you have a flat share price in the future, this yield is double the S&P 500's typical gains at 14.3%. In other words, even without the share price going up, you can beat the S&P 500 by owning this. In fact, you could beat it even if the share price goes down some. If that seems absurd, let me prove it. Because of the share price drop over the last several years, Energy Transfer's 16-year performance is only 3.4% compared to the S&P 500's 6.4%. Despite that, the massive dividend pushes Energy Transfer ahead. If we reinvested those dividends, we would have a return of over 10% with Energy Transfer and only 8.6% with the S&P 500. We would have received over $20,000 in dividends on an initial $10,000 investment. They did not raise the dividend this year, and I would not expect it to be raised next year or in future years. Then again, with a 14% yield, you don't need much growth and should not expect it. The next big question is the dividend safe? The answer depends on debt and leverage, which we will discuss later in the video, as well as their ability to weather the current crisis and grow their free cash flow. My short answer is yes. Although some have speculated a reduction in the future is possible, I believe there is a path forward which will allow them to not cut the dividend. They have never cut the dividend in the past, despite prior energy and oil crises. Looking at returns, we see a return on assets of 2%, return on equity of 9%, and return on investment of almost 10%. Is that good? Well, they are a little above average for their industry, and the returns are at the 69th, 67th, and 66th percentiles. I also want to show you some historical growth for them. This is the return on assets. Up until this year, with the crisis, it was growing nicely. I believe when the crisis is behind us, Energy Transfer can continue this sort of growth. Now we look at return on equity. Similarly, before the recent quarter, it was growing very well. Looking at return on investment, we see the same thing. Yes, it is down this quarter, of course. There's no shock there because of the pressure on energy. However, I expect a rebound, and the performance before the crisis is reassuring. Let's move to valuation. The price to earnings is a low 7. Compare that to the normal PE it has had for the last 5 years of 15.6 and the average PE it has held for the last 10 years of 22.35. This current price is a huge bargain. Forward PE is similar to the current at 7.15. The PEG, or price to earnings to growth ratio, is 1.07 and it's very close to the one that we hope for, and that is a great number. The price to free cash flow is low at 2.9 and again well below the 5-year and the 10-year averages. Price to sales is very low, price to forward sales is even lower, and price to book is looking good and just over 1. How does this compare to the industry? Fairly close to industry averages with percentiles ranging from the 39th up to the 69th percentile. Given the entire industry has been hit hard, many others are also at a lower valuation. Overall, however, I see it as very undervalued and a good opportunity despite the pressures on energy. You will rarely find a company that is undervalued that isn't under some pressure somewhere, and those moments of pressure are where we can find buying opportunities. As a quick note on the negative price to book 5-year average, that is an error calculated by the research tools I use because of a merger between Energy Transfer Equity and Energy Transfer Partners. The research tool I use miscalculated book value because of that merger. Let's look at margins. We see 26.7% gross margins, 10.1% operating margins, and 3.5% profit margins. Note that operating and gross profit margins have been growing quickly at double digits, which is a great sign. The margins are currently fairly typical for the industry, with percentiles ranging from the 40th to the 63rd percentile. Last, we look at company safety and stability. This is a big one for energy companies right now. Long-term debt to equity and debt to equity are high at 2.59. In other words, the value of their debt is about 2.5 times more than their equity. I hate high debt, but unfortunately that is how these energy companies operate, and midstream MLPs like ET have operated under a high leverage business model for many years. They function as cash flow negative. In other words, they use debt to fund some of their operations while also using earnings to pay for huge acquisitions and construction projects and fund large dividends. Looking at the industry, they are high but not unusually so, with most debt metrics between the 70th and 80th percentiles. Despite that debt, their short-term debt coverage or their ability to pay down the debt in the short term is extremely high at 92. In other words, they have the liquidity to do so quite well. Long-term debt to capital is at 0.7 and the 70th percentile. Debt paydown yield is negative as debt has been increasing rather than decreasing. Despite the leverage, they maintain an investment-grade credit rating, which is important. The current ratio and quick ratio are at 0.8 and 0.7. We ideally want this at 1 to show that they can cover all costs. Free cash flow yield is low, but that is expected to rise significantly in the coming years. Given the extreme volatility of the energy sector, the high beta is not unexpected. This shows that stock price fluctuates at 2.7 times more than the market. Overall, I don't like to see this leverage in debt. However, I am optimistic about the company because of where it is headed and its future plans, and I'm going to discuss those with you right now. I did not show this chart to you before when we talked about growth, but I want you to look at it now as we discuss the future. This chart shows, in order, gross profit, net income, EBITDA, operating income, and pre-tax income. The last bar is the bar impacted by the current economic crisis. Because I believe we will recover from this crisis, I'm essentially ignoring it for this part of the analysis. Look at the growth in all areas, consistent and strong growth across the board. This is what I like to see, and Energy Transfer has been strengthening its position and company all while share prices dropped. That is a beautiful buying opportunity. The company has been moving to change its business model to move from negative cash flow to positive. They will no longer need to take on debt and will cover all of their massive capital expenditures and dividends purely by free cash flow. That has been paying off. Look at their free cash flow per share on macro trends. It was negative for almost all of 2006 through 2018. Beginning in 2016, they began working on raising free cash flow rapidly and has recently moved positive. Looking back at fast graphs, we are looking at the free cash flow for Energy Transfer. You can see in the dark green where it has just went positive in 2018. However, look at where analysts expect it to grow from here. 28%, 70%, and 61% over the next 3 years. That's awesome. Also note the white line is the dividend. Next year, they expect free cash flow to finally fully cover the dividend. Taking a quick look at Fidelity, it shows the free cash flow growth rate for the last 5 years has been a massive 24% annually. Book value has grown at an insane rate of 101%, and the industry percentiles for cash flow and book value range from 81st to 98th percentiles. This gives more confidence for the dividend and the future. Similarly, Energy Transfer expects to be free cash flow positive in 2021 after capital expenditures and distributions had record financial results in 2019. 85 to 90% of their EBITDA are fee-based and therefore protected against swings in oil prices, and their dividend or distribution coverage was about 1.96 times, which is strong. Another interesting consideration is dividend yield theory. Dividend yield theory says the dividend yield of most companies generally falls within a narrow range. If it spikes up, it is usually evidence of undervaluation. If it suddenly drops, the company is likely overvalued and you will see it return to the average. Our current spike is the highest of all time and similar to only one prior spike. What happened when the yield spiked here? The share price rose about 177% in less than 1 year. We've already seen a near 100% rise from the spike of this dividend yield, and I expect it will continue. It also appears that the insiders, or the executives for Energy Transfer, think it is a good buying opportunity. I am showing you here a list of buys insiders made just in March of 2020. In fact, about 1/3 of the buys made in the last year were just in the last few months. Only one insider has sold in the last 3 months. In fact, the management bought over $157 million in shares in just the last 6 months. That's a strong vote, and I'm adding. It is also worth noting that even though I use the word shares here, generally speaking, Energy Transfer is considered to be in units. Some investors, especially American millennials like myself, may say that oil and natural gas are the past and renewable energy is the future. If you have a moral or a social opposition to gas and oil, then this is not the company for you. But if your opposition to investing is a belief that these companies are going out of business, you are mistaken. Simply because you want a Tesla does not mean the world will drive one. Take a look at this chart projecting energy usage into the future. You can see renewables are certainly expected to grow. There is no doubt there, but look down at gas and coal. They too are growing and will need to as the global demand for energy continues to grow rapidly. This chart shows demand for oil will double by 2035 in developing countries and those who are not OECD, which stands for Organization for Economic Cooperation and Development. In another chart, we see that the world will require 45% more energy in 2035 than in 2011. The percentage of energy from oil and gas is expected to decrease, and natural gas is expected to remain flat in terms of percentage of available energy. However, because overall energy consumption goes up, use of coal, oil, and natural gas will also continue to increase. In other words, it is far from over for energy companies like Energy Transfer, even as far out as 2050. What are your thoughts on Energy Transfer as an investment? Please share your thoughts in the comments below. I'm excited to see what you think. Take a moment to subscribe and hit the bell because I'm creating new videos for you every week. As always, good luck with your investing.